Imagine leaving $10,000 in a traditional savings account, earning almost nothing. At the end of the year, you might earn less than the cost of a nice dinner. Now imagine putting that same $10,000 into a high-yield savings account, earning over 4% annually. Without taking any investment risk, your money could earn hundreds of dollars instead. That's the difference between letting your money sleep and putting it to work. If you're trying to build an emergency fund, save for a vacation, buy a home, or simply make your cash grow while staying safe, a high-yield savings account, commonly called a HYSA, is one of the smartest financial tools available today. But here's the problem. Not every HYSA is created equal. Some advertise incredible interest rates but come with hidden conditions. Others offer slightly lower rates but provide a much better overall experience. So in this guide, we're going to cover the best HYSA rates available in 2026, how these accounts work, what features actually matter, and how to choose the best one for your financial goals. Let's get started. First, what exactly is a high-yield savings account? A high-yield savings account works just like a regular savings account. You deposit money, earn interest, and can withdraw your funds whenever needed. The major difference is the interest rate. Traditional banks often pay close to zero on savings, while many online banks compete by offering rates around 4% or even higher. Why? Because online banks have fewer operating costs. They don't maintain thousands of physical branches, so they pass some of those savings on to customers through higher interest rates. The result is simple. Your money earns significantly more without taking on stock market risk. As of mid-2026, many of the strongest HYSAs pay around 4.0% to 4.2% APY, while a handful of promotional accounts reach approximately 4.5% APY, though those often come with balance limits or other requirements. Now let's talk about what APY actually means. APY stands for annual percentage yield. It measures how much you'll earn in 1 year after accounting for compound interest. Suppose one bank offers 1% APY while another offers 4%. That doesn't sound like a huge difference, but on $20,000, the difference becomes dramatic. At 1%, you'd earn about $200 in 1 year. At 4%, you'd earn about $800. That's an extra $600 simply for choosing the right account. No extra work. No extra risk. Just a smarter place to keep your money. So what are some of the highest paying HYSAs available right now? Several institutions consistently appear among the leaders. Forbright Bank has offered around 4.15% APY with no minimum deposit requirement. CIT Bank has offered approximately 4.10% APY. Peak Bank has offered around 4.01%. Bread Savings remains highly competitive near 3.95%. Newtek Bank has also ranked among the top accounts, paying roughly 4.20% APY. Some promotional offers even reach about 4.50%, although these frequently apply only to limited balances or require additional conditions. Remember, these rates change regularly. Banks increase or lower rates depending on competition and decisions by the Federal Reserve. That's why it's always worth checking current rates before opening an account. But here's something many people get wrong. The highest interest rate isn't always the best account. Suppose Bank A pays 4.20%. Bank B pays 4.10%. Most people automatically choose Bank A. But what if Bank A charges monthly fees, has terrible customer service, limits transfers, or offers a poor mobile app? That extra 0.10% may not be worth the inconvenience. Instead, compare the complete package. Ask yourself these questions. Does the bank charge monthly maintenance fees? Is there a minimum balance requirement? Can I easily transfer money? Is the mobile app reliable? How responsive is customer support? Are my deposits insured? Those questions often matter more than squeezing out an extra fraction of a percent in interest. Speaking of insurance, this is extremely important. Always verify that your savings account is protected. Banks should be insured by the FDIC. Credit unions should be insured by the NCUA. That protection generally covers up to $250,000 per depositor, per institution, giving your savings a high level of security if the institution fails. Now let's discuss who should actually open a HYSA. The answer is almost anyone holding cash for short-term goals. Emergency funds belong in a HYSA. Vacation savings belong in a HYSA. A future home down payment belongs in a HYSA. Money you'll need within the next few years usually belongs in a HYSA. However, money you won't need for 10 or 20 years may be better invested elsewhere because long-term investments have greater growth potential, though they also involve more risk. One of the biggest mistakes people make is keeping huge amounts of cash in a checking account. Checking accounts are designed for spending. Savings accounts are designed for growing money. Even moving your emergency fund from checking into a HYSA could generate hundreds of extra dollars every year. Another common mistake is chasing every promotional rate. Some banks advertise incredibly high APYs, but after 3 months, the rate expires. Others require direct deposits, debit card purchases, or balance caps before paying the advertised rate. Always read the fine print. Sometimes a steady 4.10% is better than a temporary 4.50%. Let's talk about emergency funds. Financial experts often recommend saving 3 to 6 months of essential living expenses. If your monthly expenses are $2,500, your emergency fund should ideally contain between $7,500 and $15,000. A HYSA is perfect because your money remains accessible while still earning meaningful interest. That combination of liquidity and growth is exactly what emergency savings need. Here's another question people ask. Should you choose a HYSA or a certificate of deposit? The answer depends on flexibility. A HYSA allows you to access your money whenever necessary. A CD locks your money away for a fixed period in exchange for a guaranteed interest rate. If you know you won't need the money for several months or years, a CD may be worth considering. If you need flexibility, choose a HYSA. Another important factor is automation. The easiest way to build wealth isn't through willpower. It's through systems. Set up an automatic transfer every payday. Even $100 every week adds up surprisingly quickly. Over time, your balance grows from both your deposits and compound interest. That's how real financial progress happens. Not through massive overnight changes, but through consistent habits. Now here's one final tip. Review your savings account every 6 to 12 months. Banks constantly adjust rates. The account that paid the highest APY last year may no longer be competitive today. Switching to a better account takes very little effort, but could increase your annual earnings significantly. Don't let loyalty cost you money. Banks compete for deposits. Take advantage of that competition. So what's the biggest takeaway from everything we've discussed today? A high-yield savings account won't make you rich overnight, but it will ensure your money works harder while remaining safe and accessible. Instead of earning almost nothing in a traditional savings account, you could earn 4 times or even 10 times as much, depending on what your old bank was paying. That's free money for making a smarter financial decision. Whether you're saving for emergencies, a new car, a dream vacation, or simply building better financial habits, choosing the right HYSA is one of the easiest wins in personal finance. Take a few minutes today to compare rates, read the account details, and move your money where it can actually grow. Your future self will thank you. If you found this guide helpful, don't forget to like the video, subscribe for more practical money advice, and share it with someone who's still letting their savings sit in a low-interest bank account. Thanks for watching, and I'll see you in the next one.